What if I told you that even the greatest investor of all time, Warren Buffett, has made mistakes worth billions of dollars? Yes, you heard that right. While he's known for his legendary investments, there are lessons hidden in his biggest blunders that could save you from making the same mistakes. From a failing textile business to missed opportunities in tech giants like Google and Amazon, each mistake tells a story. Stick around, because these aren't just stories, they're powerful lessons that could transform the way you think about investing. Let's unravel these mysteries together. According to returns and BRKB reports, in 1993, Warren Buffett's Berkshire Hathaway acquired Dexter Shoe Company, a Manila-based footwear manufacturer, for approximately $433 million. Buffett chose to finance the purchase with 25,203 shares of Berkshire Hathaway's Class A stock, which were valued at about $17,000 per share at the time. Buffett was impressed by Dexter's strong financial performance and believed it possessed a durable competitive advantage in the shoe industry. He described Dexter as a business jewel and one of the best managed companies he had encountered. However, Buffett failed to anticipate the growing competition from low-cost foreign manufacturers, particularly from countries like China. This oversight proved detrimental, as the influx of cheaper, imported shoes eroded Dexter's market share and profitability. The decision to use Berkshire Hathaway stock instead of cash to fund the acquisition compounded the mistake. At the time, the 25,203 shares were worth $433 million. By 2020, those shares had appreciated significantly, representing a substantial opportunity cost. Buffett later acknowledged this error, referring to the Dexter acquisition as the worst deal he had ever made. This experience underscored the importance of thoroughly assessing a company's long-term competitive position and the potential impact of global competition before making investment decisions. According to The Guardian reports, in 2006, Warren Buffett's Berkshire Hathaway began investing in Tesco, the UK's leading supermarket chain. By 2012, Berkshire had increased its stake to over 5%, reflecting Buffett's confidence in Tesco's business model and growth prospects. However, Tesco soon encountered significant challenges. The company faced declining sales due to increased competition from discount retailers and shifting consumer preferences. In 2014, Tesco was embroiled in an accounting scandal, revealing that profits had been overstated by £263 million. Despite these warning signs, Buffett was initially slow to act. He began reducing Berkshire's stake in Tesco in 2013, but retained a substantial holding as the company's troubles deepened. Buffett later admitted that his thumbsucking over Tesco cost Berkshire Hathaway $444 million. This experience underscores the importance of timely decision-making in investing. Recognizing when to exit an investment is as crucial as identifying when to enter. Maintaining conviction in a company's future is essential. If that confidence wanes due to changing circumstances or emerging issues, it's prudent to reassess and consider divesting. In 2007, Warren Buffett's Berkshire Hathaway made a significant investment in Energy Future Holdings Corporation (EFH), formerly known as TXU Corporation, by purchasing $2.1 billion worth of high-yield bonds. Buffett's strategy hinged on the expectation that natural gas prices would rise, thereby enhancing the competitiveness and profitability of EFH's coal-fired power plants. However, contrary to this expectation, natural gas prices declined sharply, undermining EFH's market position and financial stability. As EFH's financial health deteriorated, Berkshire Hathaway faced substantial losses. In 2013, Buffett acknowledged the misjudgment, stating that unless natural gas prices soared, EFH would almost certainly file for bankruptcy. Ultimately, Berkshire sold its bonds, incurring a pre-tax loss of approximately $873 million. Reflecting on this experience, Buffett emphasized the importance of seeking a second opinion when making significant investment decisions. He admitted that he had acted independently in this instance, deviating from his usual practice of consulting with his business partner, Charlie Munger. This oversight contributed to the costly error. This episode also highlights the inherent risks associated with attempting to predict commodity prices. The volatility of markets like natural gas makes such forecasts highly uncertain. Buffett's experience serves as a cautionary tale about the dangers of speculative investments based on commodity price predictions without solid reasoning. In summary, the EFH investment underscores two critical lessons: the value of collaborative decision-making and the perils of speculative bets on commodity markets. By sharing this story, Buffett offers invaluable insights for investors, reminding them to seek diverse perspectives and exercise caution when navigating volatile markets. In 2011, Warren Buffett's Berkshire Hathaway acquired Lubrizol, a specialty chemicals company, for approximately $9 billion. This acquisition was influenced by David Sokol, then chairman of several Berkshire subsidiaries, and considered a potential successor to Buffett. Unbeknownst to Buffett at the time, Sokol had purchased 96,060 shares of Lubrizol between January 5th and 7th, 2011, prior to recommending the acquisition. Sokol's actions raised serious ethical concerns as he failed to disclose his personal stake in Lubrizol, violating Berkshire Hathaway's insider trading policies. This lapse in judgment led to his resignation in March 2011 and cast a shadow over Berkshire's reputation for integrity. Reflecting on the incident, Buffett acknowledged his mistake in not thoroughly scrutinizing Sokol's actions and emphasized the necessity of maintaining a rigorous investment process. He stated, "I made a big mistake," underscoring the importance of due diligence and ethical standards in investment decisions. This episode serves as a poignant reminder of the critical need for transparency and adherence to ethical guidelines in investing. It highlights that even seasoned investors can face challenges when internal processes are overlooked, reinforcing the importance of trust but verify in all business dealings. Warren Buffett, renowned for his investment acumen, has openly expressed regret over not investing in Google, now Alphabet Inc. This oversight is particularly notable given that GEICO, a subsidiary of Buffett's Berkshire Hathaway, was significantly reliant on Google's advertising platform for customer acquisition. Buffett observed that GEICO was paying substantial amounts per click on Google ads, yet he didn't capitalize on this insight to invest in Google itself. Buffett attributes this missed opportunity to his limited technical knowledge and a tendency to avoid businesses he doesn't fully understand. He has admitted that not investing in Google was a mistake, highlighting the importance of continuous learning and staying informed about emerging technologies. This experience underscores a crucial lesson for investors: the necessity of expanding one's circle of competence and remaining open to understanding new business models and technological advancements. Even seasoned investors like Buffett recognize the need to adapt and evolve with changing market dynamics to avoid missing out on significant opportunities. In 2017, Warren Buffett openly acknowledged a significant oversight in his investment strategy, missing the opportunity to invest in Amazon. Despite closely observing the company's trajectory for years, he admitted, "I was too dumb to realize. I did not think Jeff Bezos could succeed on the scale he has." Buffett's traditional investment approach, which often involved steering clear of high-priced earnings, PE, ratio stocks, led him to underestimate Amazon's potential. This conservative strategy caused him to overlook Amazon's rapid expansion in e-commerce and its groundbreaking success with Amazon Web Services in the cloud computing sector. This experience underscores the importance of adaptability in investing. While having a defined investment philosophy is crucial, it's equally important to recognize and adjust to market evolutions. Buffett's reluctance to venture beyond his established circle of competence resulted in a missed opportunity with Amazon. The key takeaway here is the necessity for investors to continually expand their knowledge and remain open to emerging industries and business models, ensuring they don't miss out on transformative growth opportunities. In 1962, Warren Buffett began purchasing shares of Berkshire Hathaway, a struggling textile manufacturing company, at approximately $7.50 per share. His initial strategy was to capitalize on the company's pattern of closing mills, anticipating that management would buy back shares at a premium. In 1964, Berkshire's then CEO, Seabury Stanton, verbally offered to repurchase Buffett's shares for $11.50 each, to which Buffett agreed. However, the written offer that followed was for $11.75 per share, a slight reduction that Buffett perceived as underhanded. In response, driven by frustration, he chose to acquire a controlling stake in the company to oust Stanton, ultimately taking control in 1965. This decision, influenced by personal emotions rather than sound investment principles, led Buffett to inherit a declining textile business. He later acknowledged that this move was a significant misstep, estimating that it cost him and his investors around $200 billion in compounded returns over 45 years. Buffett has referred to this episode as a monumentally stupid decision, underscoring the pitfalls of allowing emotions to dictate investment choices. The key takeaway from this experience is the critical importance of maintaining objectivity in investment decisions. Allowing emotions, such as anger or the desire for retribution, to influence financial choices can lead to substantial long-term losses. Buffett's reflection on this event serves as a cautionary tale, emphasizing the necessity of adhering to rational analysis and strategic thinking in the realm of investing. And there you have it, 7 of Warren Buffett's most significant mistakes and the invaluable lessons they offer. Now, it's your turn to reflect and make smarter financial decisions. Which of these lessons resonated most with you? Let me know in the comments below. If you found value in this video, don't forget to give it a thumbs up, share it with fellow investors, and hit that subscribe button for more insights to help you grow and thrive. Remember, every like and share helps us bring more valuable content to you. Until next time, stay curious, stay learning, and keep growing your wealth.